I think the more investing literate someone becomes, the more towards individual stock picking they will get.
My belief is, like, single stock investment is a great thing. I think it's probably at least a degree's worth of knowledge.
I disagree. Shall I tell you why? Warren Buffett has this quote where it's not the people with the highest IQ that make the most money.
The journey of Bitcoin from, $500 to $100,000, right, is one story. The point-to-point comparison of those two price points is irrelevant to hundreds of thousands of other stories, and 80% of them lost money. No other asset class in history has gone from 0 to $3 trillion and produced as little real wealth. But $3 trillion of capital deployed in the real economy would be of inordinately more value to us as a species.
No, it does. It does. I feel like it's just hidden. There are jobs in crypto, and what's happening is because it's a new asset class, it is bordering on the hidden economy. I feel like there is a market force that we might not be able to see. Those exogenous factors, I think, apply more to crypto than any other asset class.
That's right.
What I see could potentially happen is Visa and MasterCard start adopting crypto within themselves.
When we had our conversation last time, you were more in favor of S&P 500 versus global index funds.
I used to market make global index funds, and the banks and the institutions that really bought into it and were going long were doing it to diversify their portfolio.
My feeling is America's absolute dominance is probably at risk.
Welcome back to another episode of the podcast. I'm your host, Atto. We have an interesting episode today. So it's going to be more of a debate episode. So we've got two great people that we've had on the podcast before in the space of investing. So we're going to talk about a lot of different areas. We're going to talk about global index funds versus S&P 500. And a lot of people want to know more about that and want to learn more about that. We're going to talk a little bit about crypto, and we're going to be talking more about the global market. So today, on my right, I have Andrew. Can you briefly tell us a bit about yourself and the work that you do?
So yeah, Andrew Craig. I run a business called Plain English Finance, a website called plainenglishfinance.com. And I've just submitted my fourth book to my publisher. But my first one's called How to Own the World is usually one of the top selling personal finance books in the UK. And obviously we've done a couple of interviews before. And I guess just to try and finish off as quickly as possible, my stated mission is to improve financial literacy, and the way we frame that is to improve the financial affairs of as many people as possible. That's our mortal kind of locked on aim, and the reason for that is because if millions more people in this country understood finance and personal finance and financial markets properly, their lives would be much, much better, and Britain would be much, much better, which is why it's a very mission-driven thing.
It's amazing, yes. And if you haven't watched the other episodes that we've done with Andrew, make sure to go and watch that. It's been a great episode. Debodun, on my left, can you introduce yourself and tell us about some of the work that you do?
So in a nutshell, I'll describe myself as a personal trainer, but for investing.
Okay.
Right? And that's pretty much it. Before doing anything with your money, even choosing a financial advisor, setting up a will, buying a house, getting involved in the stock market, getting involved in crypto, speak to me, because I'm like the first and the last line of defense. So you'll speak to me before, and you also speak to me just before executing. Mm-hmm. And what I will do is I'll connect you to people I feel you also need to speak to. So I've got a whole list of tax advisors, I've got a whole list of financial advisors, and more importantly, I've got a whole community of like-minded people trying to do the same. So you can connect with them also. I do lead with the stock market because I feel like that's the forgotten asset class. I think bricks and mortar, if you go back 1,000 years, we bought land and built houses. Your ancestors have as well. Whereas with the stock market, a lot of people look at it as a casino rather than a way to own a piece of existing businesses. And a lot of people that look at it as risky don't mind putting money towards their friend who just started a business, which is actually far more risky if you look at the risk profile of it. So yeah, I run an investing community and I'm an investing coach, and I teach people how to invest in the stock market.
Okay, thank you. Okay, so let's get started we'll start off with the basics of investing. So Andrew, I'll start with you. What are some key things you think people really need to understand about investing?
Yeah, so to your point, I mean, it's basically you want to be invested, right? It's absolutely, it's life-changing. Done well enough over a long enough period of time, largely the richest 1% in the world nowadays, when it's far more meritocratic than it was in the past, are to a large extent the most financially literate 1% of people in the world. As much as that's quite an unpopular statement, it's kind of quite easy to credit. So if you learn about investment, if you understand investment, and basically how do you do that if you want to capture in a nutshell? Well, you want to understand the main investing asset classes, and that those are property, stocks and shares, bonds and cash, basically, and real estate, and nowadays crypto's the new one, right? If you have a basic grasp of all of those things, and crucially, if you have an age-appropriate way of using the right mix of all of those things, which we can probably come back to, you have a really, really good chance of making returns that over a long enough period of time will be completely life-changing. And the difference between doing it and not doing it is we always say, even if you're on a sort of average British salary, is the difference between having a large 6 or 7 figure sum kind of 30-ish years after you start doing it, like the conventional sort of pension trajectory, and not having that. High 6 figures, low 7 figures is entirely realistic for somebody on a median British income to achieve if they invest from the minute they can afford to invest until the time they want to retire. And of course, along the way, you should, by rights, also have more money for things like a wedding or a holiday or a car. And if you borrow money and go into debt, that will compound against you really, really aggressively because the interest rates on borrowing money are really high. If you save and invest, you'll make much lower returns than what you'll pay on debt. But the difference between those two curves over time is that after only a few years, a borrower is massively in debt and an investor's like many, many thousands, if not tens of thousands, and eventually hundreds of thousands of pounds if somebody uses debt. So sorry, that's a long, rambling answer, but that's trying to sum it up in a nutshell.
No, I appreciate that, and I understand what you're saying. It's like what you're describing there is obviously the effect of compound interest over time, and it can work for you or against you. And
global growth, because the other point I make, but to exactly to your point about the stock market, right, is the stock market isn't like people's ripping each other's face off. I always talk about the difference between investing and trading, right? The reason that the stock markets go from bottom left to top right over time is because of human progress. So that's population growth and scientific, technological development. It's like a century ago, we didn't have airplanes, we didn't have shipping, or we had nothing like the shipping we have today. We didn't have skyscrapers, we didn't have high-speed trains, we didn't have internet, smartphones, and, right? And the reason that stock market investment creates wealth, real wealth over time, for anybody who's willing to get involved and find out about it, is because of that. It's just because the world is growing and of technological progress.
Amazing. Thank you. Debodun, what's your thoughts?
On
same question. Actually, let me ask you the question again. Yeah,
you should let him go first next time.
I will do it. So what are some key things you think people really need to understand about investing?
I think the pathway to investing can be simplified to I get a job, or I get an education, and then I get a job, and then I earn an income, and then I take a portion of my income and I save it, and then I take a portion of my savings, and that becomes my investing pot, and that investing pot is split into two. You've got your emergency cash, and then you've got what's left, and that again will be split between different asset classes depending on your stage of life. I don't like the term risk profile because I feel that the more educated someone becomes, I've seen it. I've seen the most risk-averse person now buying Bitcoin because they've educated themselves on the cycle, on risk management, on how to size investments into riskier products. So actually, I've come to the conclusion that most people are not qualified to determine their own risk profile.
Okay.
And as a coach, your job is to challenge them. So if you look at what they're educated on and where they're at, and you add education to that, they can then be more informed to determine what their risk profile is. Because if you invest in the riskiest thing in the world, but you only put £1, that doesn't make you a high risk investor. But most people say they're not going to invest anything at all into the riskiest thing in the world because they're risk averse. But if you look at their spending habits, that risk aversion profile goes out the window.
with their car payments.
You look at their car payments, you look at their debts, you look at how much they spend on furniture, the fine dining, and they're living a life of luxury. And then in the investing world, they say they're risk averse.
Okay.
So for me, it's all about education and approaching it in the right way.
Yeah.
And people learn in different ways.
And it's the mix, right?
Yeah.
I think that's the most, because there are different asset classes that do different things.
Yes.
And they do different things at different stages of an economic cycle. And, what we're always focused on is getting a tangible outcome in a really sort of safe, considered way by just getting the mix right.
Yeah.
Which anybody can do with a little bit of knowledge.
It's actually one of my favorite words in investing is your mix.
Yeah.
So you'll know from the group when I'm coaching people on how to even pick, let's just say stocks. It's about the mix, right? Most people think diversifying your portfolio means just having stocks from different
stocks. Exactly.
7 tech stocks in different sectors of tech, or having 7 stocks from different industries. And that's just one factor of diversification of 20 to 30.
Yeah, exactly.
So when you really look at what an optimal mix is, your optimal portfolio has a mix of all those different factors.
Yeah. Okay, so let's move on to the next question, right? So we want to talk about active investing versus passive investing. So Debodun, I'll start with you first. So is picking individual stocks a smart path to long-term wealth, or index funds, ETFs, simply a better bet for most people? And why do you think that?
I think for most people, passive index funds investing is their better bet. But that's only because most people are financially illiterate. Okay. So it goes back to what I said earlier.
Exactly.
Right? I think the more financial, I don't even like the word financial literate. Investing literate.
Yeah.
Is a subsection of financial literacy. Right? This is when you're trying to get your money to work for you, what do you know? I think the more investing literate someone becomes, the more towards individual stock picking they will get.
Okay.
So someone that maybe starts with index funds, starts to learn more, starts to become more interested in, and sees the returns that it's making, will have a eureka moment where they think there must be more.
Yeah.
Even if it's just adding one stock, right? And that stock is maybe Meta 2 years ago when it was at 100. A stock they know, a stock they use, a stock that they don't need to be educated is a good company.
Yeah,
right.
The valuation piece is the key bit they need to be educated about.
Right. There are some companies out there that you can ask the man in the street, is Amazon a great company? And they'll confidently tell you yes.
Yeah.
So then if that person gets told, oh, by the way, something's happened in the market and Amazon has gone back to the same price it was in the year 2000, that person with that information will be more inclined to invest in Amazon, the company, as well as leave their S&P 500 to run, right? And in doing so, what they then need to be educated on is their strategy, their sizing. How much do I put on, right? Do I buy more if it continues to fall? Do I sell at any point, right? So strategy and risk becomes far more important than how good a company is. But yeah, to answer your question, I think the more financial literate someone gets, investing literate someone gets, the more they will go towards individual stock picking.
So you think they should, it makes sense for, so not that obviously people in terms of investing literacy, obviously we know it's low, right? So you start with that as a base, but you should invest in your education, invest in education to get better at investing, and then potentially look at becoming more of an active investor.
If I can chip in on it, like, so I've got a second book called Live on Less, Invest the Rest, and this is also in a YouTube video of ours where I basically list out a long laundry list of things you need to know before you buy a single stock. Yeah, which is basically what any professional investment manager in the city will have, at least that number of things, and it's like 25 things. And it's like, what's EV EBITDA? What's the return on capital employed? What's the return on invested capital? What's the PE ratio? What's the balance sheet? What's the exogenous factors that might affect the company? How many shares does management own? How much short interest is there in stock? Which institutional investors? So my point here is, my belief is, like, single stock investment is a great thing, but I think it's probably at least a degree's worth of knowledge before you can do it safely. And possibly a PhD. Like, I'm serious. Like, to be, if any of you spends 10 minutes watching the video I made about this, it's like stuff you need to know before you invest in a single stock. If you've got to look yourself in the mirror and say, I understand absolutely everything you just said. and I understand how to analyze it, and technical analysis, or like you want everything. And if you don't understand all that stuff inside, and by the way, if you're not, and you need to be an A grade student, because it's like saying you don't want a brain surgeon.
I disagree.
Or an airline pilot who got a D in their exams, right? Because they could kill you, right? And my view is that you don't want to be trading or investing in single stocks unless you're an A grade student. And so which
I disagree.
Well, yeah, I know a lot of people do, but I've spent 25 years watching people lose money. So
shall I tell you why?
Why?
Warren Buffett has this quote where it's not the people with the highest IQ that make the most money, and I've seen it.
Yeah.
If you had Warren Buffett sat next to you or digitally in a WhatsApp group, that you had access to him all the time, do you still need to personally understand every single aspect of that list? Or do you just need to have a vague, reasonable understanding of what each thing does? I think your probability
of finding someone who is actually consistently good is low, especially if you don't have that grasp, your own personal understanding. You might be lucky and find somebody who is genuinely good and genuinely understands everything I've said. Statistically, you have probably a 90% plus chance of the person not being those things.
I agree with that.
Look at the UK market, right?
I do agree with that.
Yeah, but so then how does somebody interrogate whether the person they're choosing is the 10% that might be good and add value or the 90% who are bad? And so to me, that's an asymmetric risk and an asymmetric bet. So it's a much better idea for the average person, because the average person has no way of telling whether they're getting a Warren Buffett or a bloke who has just woken up last week.
Right, let me throw a curveball in there.
Well, yeah, go on. This is good. This is turning into.
This is a dark. This is a dark.
We've got a lot of Venn diagram overlap.
This is a dark curveball.
Yeah.
So, God forbid, person A has a heart attack.
Yeah.
Right, but doesn't die.
Yeah.
Right, ambulance is called. They're on their way to hospital.
Yeah.
They get there. Someone says, "Need to put him straight into surgery."
Yeah.
And the patient has to give permission.
Yeah.
Right? Has he met the surgeon at this point? Does he have time? Does he have the opportunity to really critically assess whether that surgeon just came out of uni, just qualified as a consultant, how long he's been around, how many of these operations he's done? Has he done it on fat people, thin people, tall people, short people? Yeah. Or is there an element where he trusts that hospital, right? He trusts the system.
Yeah.
And is that okay? And why can't we then use a similar logic here?
We do, and it's called FCA regulation. But 90% plus of influencers and people trying to teach people about financial services are not FCA regulated.
Do you think that FCA regulation is the benchmark?
No, but I think it's the bare minimum. Like because if you're not FCA regulated, you haven't passed any of the exams, right? So, or, you might have passed other exams, and to be clear, there are lots of FCA regulated people who are rubbish, for sure.
A lot.
But 100%.
So then you have to look at but every surgeon has passed these tests as well.
Yeah. But I think I like your vignette. I think it's quite interesting, but I think the life and death situation of dying of a heart attack is a bit different to doing a slightly better job with your money than just, owning an index.
Yeah, I feel like the point you're making really is vetting. Right? Yeah. And this is why I don't like the term "do your own research."
No, 100%.
Because it's a cop out.
Well, and also
you've given someone an idea, you've planted the seed, and then you said, "Do your own research" to a beginner who doesn't know how to do
100%.
their own research.
100%.
It's a cop out. It's you covering your ass.
But that's why. I mean, I think what we would probably agree on is one of the things I treat a lot in my work is the difference between investing and trading.
Yes,
philosophically, and it's very poorly understood, and particularly now with with the rise of crypto and the rise of influencers and FX, spread betting and everything. And there are probably significantly more people online advocating trading strategies than there are boring old men like me advocating investment. Right, investing's worked for 200 years. And if you learn about it, you have a very high probability of success because it's real. It's the real economy. It's what I said earlier. It's like you're just getting a financial exposure to genuine human progress, technological advancement, etc. Trading is much more. You're ripping somebody's face off. You're winning because somebody else is losing, particularly in the crypto space, right?
Yeah.
And trading's much harder. So my view is, so I would place single stock investment actually in trading effectively.
Would you?
Right? Yeah, I would.
Okay, interesting.
Because they are philosophically similar, especially if you're talking about relatively short term single stock investments. Like you buy Amazon this month and you sell it in 6 months' time.
Right.
But what about if you buy Amazon with the mindset of I am willing to hold Amazon for 10 years?
Yeah, that's
right.
That's fine.
But and here's where my strategy and the way I look at single stock investing starts to be different to most long-term investors. You see, most long-term investors, they want to buy and hold. And that for me comes with an element of laziness, right? You're a long-term investor because you bought it and you've held it for 20 years, right? But if you buy something, a stock, and you're okay with an annual return of about 20%, which means it's doubling every 4 years, right?
Yeah, you're very lucky if you've achieved that.
Exactly.
Yeah.
So let's say that stock doubles for whatever reason in a month.
Yeah.
You've achieved what you thought would happen in 4 years now. Yeah. So you would sell.
Yeah,
but someone will look at you and think,
well, if you'd sold Nvidia when it doubled, you'd have missed out on another 15x, right? This is the point. Any kind of stock market investment, you need to have a very, very clear idea of valuation and technicals. So that if it doubles, and you have to have a written down thesis why I own the stock, right? So that if it's doubled for a reason that's commercial delivery. You know, the revenues are fantastic, the margins have gone up. But it's still on a PE ratio of 15 or a PEG ratio of 1, which you need to understand what that means.
Yeah.
Then you wouldn't sell it. But if it's doubled and it's now on a PE ratio of 200, you know, and its balance sheet's challenged and they've had a profit warning, they'd sell it. So but this goes back to my investing versus trading mentality thing, because investing is something that anyone can learn to do. Anybody who's vaguely intelligent, and to do really effectively and make a life-changing difference to their life, right?
Yeah.
That doesn't mean you're going to make 20% a year. Like, you'll be likely to make high single-digit, low double-digit returns. But what very few people understand, because 60% of people don't understand compounding, is that high single-digit to low double-digit returns is life-changing for like most people, right?
Yeah,
done every year for many, many years.
Yeah.
But that's super. You don't need to like that. If you like, that's the Pareto principle, the fastest route from A to B to get a tangible, life-changing outcome. All the other stuff has its merits, whether it's crypto or FX trading or single stock stuff. But the probability of success is much lower, and the amount of work you need to do is much higher. But if you get investing sort of with like 80% of whatever it is you can put to work, and have 20% for playing around and buying Amazon and selling it for 100% and buying Nvidia and buying some crypto, that's great. I think the tragic thing we have right now is we have a whole generation of young folk affected by TikTok and
who are day trading.
And they are going straight past investing to trading.
Yeah.
80% of them factually lose money.
Yes.
80% of them.
Yeah.
And the real problem is that once they've lost the money, they give up on all financial stuff, including investing.
Yes.
Because they don't know the difference
We're
between
on the same
investing
page on
and
that.
trading.
Yes.
Yeah. And so I think, I think exactly we're on the same page.
I operate on, so before working in a quantitative hedge fund, the way I thought about investing was very similar to what you're saying. And then obviously you work for a quant hedge fund, which a lot of investment banking traders don't actually end up there, because once you become a VP,
computer programmers,
right? Once you become like a VP or something, it doesn't work for income, because they like to bring in people at a certain level. But what I saw there was quite life-changing in terms of their approach. Emotion is completely taken out.
Yeah.
And most people think quant traders are high frequency, in out. No, they're actually quantitative strategies that are holding positions for like a year, 2 years, 5 years, right? And
although there are the ones that do 100,000 trades a week.
They have both,
right? Yeah, exactly.
Right. So they got their really fast strategies for day trading, then they've got their long-term investing quantitative strategies. But that's where most of the time gets spent, monitoring your long-term positions and optimizing the factors each day. But what I noticed was that there is a way to take some elements of trading and apply it to your long-term investing.
Yeah, for sure.
For example, the notion of profit taking. I know you mentioned PEG and PE ratios changing and balance sheets being challenged as one of the key things you can think about.
One of 200. Right?
Yeah, one of 200 things that you
yeah.
can think about. But even with just a simple take profit strategy that says, listen, if I go in with this belief, I'm willing to sell if it does 200% when I was ready to sell 100%, especially if it happens within a specific time frame. And once I've sold, I just sit back and watch to see if it can actually dip again, or and if it doesn't dip again, I'm okay. There's going to be so many more opportunities in the sea for me to take advantage of.
100%.
So having some of the, for example, chart work, looking at the technical analysis, there's some long-term technical analysis charts that you can look at and signals that you can look at. 200
AMAs, EMAs.
I look at
bands,
I look at the Bollinger Bands. I look at the stochastics. And they've been very good to me.
Yeah, they are. And trailing stops.
Yeah, they've been really good at so for example, some of my clients took off like multiple 7-figure S&P 500 in February, right? And it wasn't just on a whim. We looked at forward PE ratios of the S&P 500 and what the next decade returns have been at different levels. And what we saw is that the current level it's at, the forward PE ratios of S&P 500, the next decade, the S&P 500 should average 5%, not the 10% and 25% we've been enjoying for over the past 15 years. And on that basis, there was already like a checkbox around what liquidating S&P 500 could look like. Technically. And then we also looked at the chart work, the technicals, and the technicals were saying that everything was above the 80 line on the RSIs and the stochastics as well.
You never sell until it comes back through.
You guys are so technical. I'm going to feed you and I need to answer your question.
Yeah, there's ChatGPT. Okay. People can like...
Yes, please ChatGPT, but we'll explain some of these terms. Hopefully,
right? But there's another exercise that I did. I looked at what the S&P 500 was in 2010. And I said, if S&P 500, we know it's outperformed the 10% annual average from 2010 to now. But if it hadn't, where should that level be in 30 years? So like, say 2040.
Right.
And where should it be in 30 years? And that's what I use as a guideline. And I was able to see that if I got this decision wrong to sell, to liquidate, my penalty wasn't that significant from a annual percentage basis from 6,000 up to maybe 8,500 in the next 15 years. So there was enough sound, credible data, facts, looking at forward, because we're trying to outperform.
Did you get back in since? Because it's back
absolutely, because using that the same
buy signal,
through
30 on the RSI. Sorry to interrupt, but I'm just conscious because this makes our point, right?
Yeah.
I feel you're sitting there thinking, guys, this is probably going to be really technical for our audience, right? That's my gut feel. And this is my point.
So at the time we sold, we knew that, guys, if we can improve, if there's going to be a bear market, which is a 20% drop from all-time highs, the level's 5,000, right? If we get anywhere close to that, right, from even 5,500 or down to 5,000, you will rebuy back your whole position because you've already got a reasonable enough price improvement, right? So we weren't selling to buy back. We were taking profit, waiting, knowing that if and only if we saw that, we would get back in. Right?
But this goes to the broader point.
And if we didn't, we knew what the penalty was. The percentage of people
that can consistently, successfully do that is tiny.
Yeah.
Like empirically, right?
Yeah.
And also the percentage of people watching this now, without wanting to belittle your audience, because it's true of the whole population, not just your audience, right?
No, you're spot on.
Including graduates and people with PhDs.
Including
and a lot
traders
of people in the city,
with 20 years experience.
Correct.
Right?
And so, but this is why I always come back to, like, just know the difference between investing and trading and make sure you get investing right first. Like that is a huge
as a base
argument of mine.
Yeah.
So I've seen this signal, by the way, let me just add, I've seen this signal 3 times in 10 years. The last time was February 2020.
COVID, yeah.
Just before the crash.
And then the S&P bounced 63% from the trough in 8 months. Yeah.
Right. What we did on this April 7th period, we did then. Right. And the last one was, I wasn't even active then, but what was it? It would have been a 2014 time. The I think S&P at the time was about 2000.
It fell about 12% in 2018 off the top of my head. That was its last big down year. Or quite down.
But it was a while. It was around that period. And so the reason I'm making that point is so it's not like this happens regularly and we're in and out and in and out. But I've made some very, very big calls on both the take profit and the dips. And when I make these calls, I'm having conversations with multiple people that also respect in the city to get scrutinized. And the most important thing for me is actually knowing what the penalty is of being wrong.
Yeah.
Right?
Capping the downside.
Right. What's my penalty of being wrong? Okay, cool. We just buy back in a little bit higher. If
you also make a really good point on this whole theme, because when I'm talking about a laundry list of stuff you probably need to know before you ever like buy, even Meta or Amazon, you know, whatever stock you, and certainly a little risky mining stock or something, is the sell. Because like 99% plus, and some professional investors do this too, but 99% of amateur investors come up with all these reasons to buy something, which will range from my mate told me about it in the pub. I like their product. You know, it's really whatever. It's going to cure cancer, whatever it might be. It's about to discover gold in Kenya or whatever. To a really good analysis of like its PE ratio is this and this growth rates are that. But what they never do is establish a sell plan when they buy. And that is how Warren Buffett makes his money.
That is fundamental to the strategy that I use.
Exactly.
Fundamental to the strategy. Because it's like media headlines as well. When Warren Buffett sold airlines, they were so quick to count how many billions he lost.
Yeah. Well, you know that Buffett quote, how do you become a millionaire? Start as a billionaire and invest in an airline.
I was going to say, actually, just to add. So it sounds like, from what I was hearing from Andrew, it sounds like you're saying in terms of investing, when people get into investing, it's looking at, it sounds like index funds, ETFs. That's where you should start.
Real nuts and bolts.
Yeah, you shouldn't be trying to become a
pension,
trader. Yeah.
Big picture, the main asset classes. Exactly. And the crucial thing is, do that as soon as you can.
Yeah.
Yes.
25 quid a month. Yeah. As the minute you earn any money, get it done. Because 25 quid today will turn into a hell of a lot more 30 years from now at 8 or 9 or 10%, right? To get that done and don't delay and don't, because you can do, that's a relatively small amount of information you need. I always say it's no harder than learning how to drive a car.
Yeah.
You've heard me say that analogy before.
Like, I use that. I like that.
Yeah, it's a good one. Like,
driving is like, one of my most used analogies.
Yeah, the automotive analogy.
The cost to drive a car. Yeah. You don't just jump in a car and go and drive from London to Manchester.
Exactly. Because you'll crash.
You do the license. You learn.
You learn for 10 months.
But also, 80% of British adults have got a driving license. It's like 40 million people or whatever. And how many hours does it take for the median intelligent person to learn to drive a car? Like 10, 15, 20, 30, I don't know, whatever.
It took me longer.
Whatever. So, some people can do it in 3 because they're going to be Ayrton Senna or Lando Norris, and some people can do it in 30 or 50 or whatever. But my broad point is that learning how to drive your finances, and I'm talking about investing, not like knowing whiz-bang stuff about trading or whatever, is roughly the same number of hours. And 90% or 80% of people learn how to drive a car, and 0.8% of people learn how to drive their finances, which to me is insane.
Yeah. Would you say that cars are incredibly risky?
No, exactly.
Do you think that they're dangerous?
That's exactly the
no, I'm asking. I do.
Then, they're
every time
more
you
risky than investing.
Okay.
For your life to your life.
Right.
Your life.
Okay. Yeah. So then, a question for you: do you need to be a mechanic to drive a car?
No, but you do. But you do need to have passed your multiple choice test and learn the highway code, and you need.
Correct.
That's the point.
So you don't need total education.
But a mechanic's a
you
trader.
just need enough.
But a mechanic is trader level, right?
Right.
Oh my God, we're using car.
And just being able to drive a car is investor level.
Right.
That's my point, right?
So does that investor need to be trader level to be able to learn? Because when you drive a car, you are learning a bit about the engineering, but not all of it.
Yeah.
Right. So it is a trading meets investing. It is a engineering meets moving
Well, no, but
from
I'm just,
A to
I'm
B.
just, I'm just saying in the analogy that driving a car, knowing enough to drive a car is the same as knowing enough to be an investor. Knowing enough to be a car mechanic and work on an engine is more like learning how to be a trader or a single stock.
Is there an in between?
I think you have to be very careful.
I was gonna ask you actually. So over 70% of people who watch these episodes are subscribed. If that's you, hit the subscribe button. It really supports the channel, it helps it grow, and most importantly, lets us keep bringing you valuable conversations like this one. Plus, you'll be the first one to know when new episodes drop. Thank you so much for your support so far, and enjoy the rest of the show. So, in terms of where do you rank, single stock investors? Obviously, we talked about index funds. It sounds like all investors, that's their starting point. But in terms of like the next steps, where do you kind of rank stock investing? You mentioned 80%. That's
yeah, I mean, it's ballpark. All I'll say is that basically, if you get investing sorted as soon as you start earning any money, if it's all possible. First, you got to pay off debt, which to your point, you got to have a pot of cash to rainy day.
I've got a view on that.
Oh, okay. Well, expensive debt at least, But
yes.
I'm not including mortgage debt or student loan debt, or I'm just saying like store cards with 25% APRs and all that. But hang on, but the broader point I was going to make is, so once you get that going, it's like changing the trajectory of an airplane going from Heathrow Airport, like 1 degree. Instead of ending up at Boston, it ends up at Rio de Janeiro, right? Because over many, many years, a savings habit and an investing habit will, from as soon as you can do it, will start accruing capital. And then you'll see that and you'll be like, wow, this is kind of cool, and you won't see a huge result within the first 2 or 3 years or whatever, but this is something you have to be locked on to do for your whole adult life, right? As a gilt-edged life habit. But the point I was going to make about hierarchy of riskier versus less risky stuff is, I would say that once you're a few years into that trajectory, you'll then have enough capital and enough confidence to then learn about things like single stock investment. Because you start doing single stock investment when you've got $2,000. It's a complete waste of time because it's a whole load of work. But the absolute returns you might make with, a percentage of your $2,000 is pointless. Okay. So if you do something really simple and fundamental for a few years until you've got a lot more than $2,000, maybe in your early 30s if you start in your 20s or in your mid 30s, and then hopefully you might also, you know a bit more about the world, you'll be a bit better educated, you'll understand more what companies do, and it's at that point that I think you can start introducing more risk. And I think everyone should as well. I think as you get older, it's almost your duty. And I like, for example, I often say that I think the perfect person to be doing trading, for example, is actually ironically probably somebody who's at or near retirement, because they got a load of capital, so they don't have to risk much of that capital to make quite a serious, if you've already got a big pension nest egg or a big net worth, you can use a relatively small amount of that as trading collateral in a spread betting account or whatever, and actually make quite a lot of money without risking very much of it. And you've also got time in your hands because you're not at the thick of your career or raising kids or whatever you might be doing. So look, I sense you've got a different view, but that's just for me,
just a slightly different view on the retirement piece.
Because you want to build the capital to get there. I just
feel like I totally agree with you on having a larger capital base and using a percentage of profits or that capital base to then try riskier investments. Because there's a variation of that I teach and coach. So, for example, even within the stock market, there's lower risk and higher risk. Yeah, of course. Even just looking at market cap. So let's say you invested in Meta and it's done 8x, and your 1K investment is looking like £8,000. You can take 3K out of that and say, okay, I'm now using that as my maximum budget for biotechs or higher risk plays, such that if that doesn't work out, you're still largely up. The thing with the pensioners, and I don't even think it just affects pensioners, trading is one of those things that can lead you into a gambling habit.
Oh yeah, absolutely.
So the mental side of trading is something that as you get older, you probably may struggle with a bit more. So even though the principle works as you explained it, the reality of it could be that they actually blow their pension in this.
Depends on the pensioner, right?
I mean, look,
but pensioners have I feel like their mind can just some pensioners, I feel they get to a point where something feels a bit good and they're getting a little thrill out of it, and maybe like a lot of people,
like
old people are lonely.
Whiskey scams.
Yeah,
a lot of them get taken for a ride by scams.
They get very get rich quick,
But I think but in my scenario, I'm talking about people who've, by definition, now spent 30 years learning about investment and doing
Right,
okay.
so
Yeah,
correct.
it's
just an additional, maybe in your 40s, you've got a bit of capital, you start doing a bit of single stock investment because you have time and you figure out you've got a bit of capital. And then as you get older, then you learn more and more sophisticated strategies. But what I think is absolutely terrible in our culture right now, driven by social media and TikTok and whatever else, is a whole bunch of 20-somethings believing that they can turn 100 quid into 100,000 quid in 2 years, or and the cynical people online who it's insane they're not regulated, right? Because the crazy thing is I'm regulated, right, and that I have to keep records for 6 years and pass exams and do jump hoops left, right, and center, right? It's very expensive.
Yeah.
And if I decided tomorrow that I want to just promote crypto, I wouldn't have to do any of that, and that is a national outrage, So there's all these people promoting crypto who've never studied economic history. They don't know
Donald Trump
valuation.
Tweeting to buy a meme coin.
Yeah.
Did he?
He's not FCA regulated because he's in America.
I mean,
but he's allowed to do that.
United States.
But and I talk about this a lot. The journey of Bitcoin from $500 to $100,000, right, is one story. Okay, but it doesn't. And the point-to-point comparison of those two price points is irrelevant to hundreds of thousands of other stories as what has actually happened to individuals on that journey, and 80% of them lost money. 80% of them lost money because what happens is you buy it at 40,000 because it's gone up, and you're like, well, your mates, everyone's been crypto, buy it at 40,000. Then it sinks down to 20,000. You go, oh man, I've lost half my money. What if it's going back to 5,000? I'm going to sell. So you sell. Then it goes back up to 100,000, and you're going, oh my god, I've basically lost a load of money and not bought back in. And unless you have really, really high level of sophistication and, to your point, mental toughness, psycho-emotional discipline, and you really, really understand this stuff, you should be nowhere near it. Because 80% of people lose money, even when it's gone from $500 to $100,000. 80% of people have still lost money.
I think my stance is when you're younger, you can take risk.
There is that.
But I have a big...
But do that in your career, not in your investments.
I have a big thing on how you take that risk. So you might... my stance has evolved over time. During lockdown, I saw so many university students turning 1K into 100K, turning 5K into $1 million on, doing venture capital crypto where they're getting pre-ICO and then it launches and does.
How many of them still have that now?
They were making that money and disappearing off my social media radar. A lot of them I didn't see or hear from.
Statistically, very few of those people still have the money because the mindset that allows you to make supernormal returns like that is the same mindset that thinks you can go again.
Yes.
And doesn't understand risk. And 90%, well, statistically 80% of people lose money trading. I would say 90% of people who have that experience because they don't have the skill or the knowledge to put it into gold or bonds or a private S&P bank or whatever, right? So what goes up comes down.
They end up spending it. The bit they don't lose, they go and
look at all the
splash
celebrities.
it.
Look at Boris Becker and Karen Millen and there's some horrendous statistic on the number of NFL, NBA, professional footballers
that go bankrupt.
People who used to make loads of money and they're bankrupt within 5 years because they make a load of money but they never learn. The simple stuff I teach, the investing bit, which is tragic because if you ever make that sort of money and whatever,
it's like winning the lottery. You see the same thing.
All you need to go, actually, if you want to then just lie on the beach and have an amazing life, to the extent that's what you want to do, all you need to do is have a really good private bank. But, most people who make this money don't even know what a private bank is, right?
True.
You'll have to pay them like 1% a year or 0.6% a year, but you can just give it to a really good quality private bank and they'll make sure you generate loads of income and you never lose it.
I was going to say, obviously some of the big financial firms are getting into it, BlackRock. Right, as well.
What you mean, crypto?
Into crypto,
right?
Because BlackRock, Fidelity, Goldman Sachs. So Morgan Stanley here. They're embracing it. So what's your thoughts on that?
So bear in mind, these companies are commercial. So if there's a hot space, they're going to have a product for the hot space, right? Okay. So anything that's exciting, like that 20 years ago it was gold. Let's make a gold ETF. People love gold, but more people are buying gold. So they produce a product for the market to make money out of that market, right? Okay. Embracing it is overregulating it because BlackRock's got more than $10 trillion. And even though the crypto ETFs have been really successful, it's still a tiny, 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 tiny fraction of that, right? So, if BlackRock was truly embracing crypto, they would be putting their own proprietary money into 10% into crypto, that would be $1 trillion. Well, they ain't done that because that would be half the value of the whole of Bitcoin, right? So this is people who don't really understand these things. It's fundamentally fallacious. Like I say it all the time. Oh, the UAE are massively into crypto. Like Mubadala, right, is the sovereign wealth fund of much of the UAE.
Yeah.
And they've got, off the top of my head, it's something like 400 billion of assets. And somebody makes some post on social media saying they've put 500 million into crypto. That's like you and me putting, 2 pints of beer worth into such, right? So there's a lot of nonsense talked about this. The other thing is Blackrock aren't investing as principal. They're not putting their own balance sheet capital into Bitcoin. They're providing a product for retail investors to pay them to put their money into crypto, right? So how much of a commitment is that? And so these are things that it's really important to understand before you read, the people who 3 months ago had never passed a financial exam in their lives and don't know anything about the stock market and the 2 centuries of history that I know about, and now they're a crypto for influencer, right? Be careful.
It's just one of those things like William Hill, Ladbrokes. They're into sports betting, but they're on the other side. They're market making. That's what Blackrock are doing with crypto.
Exactly.
Right?
And which also, just quickly, because it's another thing that annoys me so much, is seeing all these genuinely clueless people railing against BlackRock and Vanguard because they own 8% of every company in the world. So they're this evil empire backed by the Rothschild family and the cabal of lizard people like the Queen and Bill Gates, which just totally fails to understand what these companies are. To your point, Vanguard own like 8% of every single large cap American company because they're owning it on behalf of tens of millions of small underlying investors. They're not investing as principal.
Yeah.
So if you buy that ETF, you put, if you're lucky enough to have 100,000 quid in the S&P 500, whatever,
that will go towards it.
And you choose to use a Vanguard ETF to do that, or a BlackRock ETF, or a State Street ETF to do that. Vanguard and State Street aren't making any substantive decision to own Apple. Or they're the
just beneficial
taking all that
owner.
money and giving you a mechanism to buy it. And it really annoys me how few people understand this and how much nonsense there is online about they're like trying to control the world, because it's totally wrong.
It's simple market making. And market making is for me to honor your returns.
And give you access
the physical asset.
Yeah.
Right. So when you're buying the S&P 500, they are going out and buying it on your behalf and passing you on the return.
You're holding,
and by doing that over a large scale, they become large owners.
And it's a great invention because, imagine if those things didn't exist, if ETFs didn't exist, and you wanted to own all 500 companies in the S&P. Imagine how long it would take you to. You're going to call your break and like
mutual fund industry.
Maintain it as well.
Exactly.
Yeah. So then, what is your stance on crypto? Does it sound like? Because we've had this conversation before.
Yeah, a little bit.
So are you not a fan of it at all?
So no. I think
even a little portion.
I think it's really interesting. I think Web 3.0.
It's been around for a while now.
Yeah, correct.
And it's not.
And look, ultimately, we've got a bond crisis brewing. In America and Britain. There's a potential kind of end to the dollar monetary system. Like seriously, America's got $200 trillion of debt, 40 trillion of government debt, was 9 trillion or whatever. And that's all what's going on this year, and the tariffs and the blah, 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 and the Elon Musk and, Doge or whatever it's called, Doge. But so all of that, all the arguments for Bitcoin in particular as like digital gold are compelling and important, right? But you should still consider it to be a speculative investment. And you were saying earlier about how like it's about appropriately sizing your
categorizing it correctly, and that category should then lead to how you size for it.
Exactly.
Right?
And the problem I have is that we live in a world where a very, very significant percentage of let's say under 40s are all in on crypto. They've drunk this bullshit Kool-Aid through pure ignorance that, we should never invest in shares, or like the pensions are rubbish, or it's just total ignorant nonsense, right? Because they've never actually learned properly about how it works, and that's the real economy. And they've drunk all this Kool-Aid from largely disingenuous, dishonest people saying, buy my crypto course for 2,000 quid, right? And so they get told this yarn about the fact that you should only do crypto, and that is fundamentally extremely stupid and extremely dangerous. And actually, just sorry to sort of monopolize the conversation, but I'm really passionate about this. This is a really important point to get out. The other point about crypto is, if you put money into the stock market, smaller companies, right? I was in the team that floated EasyJet, right? $200 million or whatever we raised to buy a load of airplanes, right? Pizza Express opens a load of pizza restaurants. You know, Games Workshop makes nerdy little lead figures for boys who want to do Dungeons and Dragons, right? My point is, when you raise money in the stock market, that money is then deployed in the real economy to do real things. That employs people, pays tax, takes out leases on buildings. You know, that is the lifeblood of our economy and what creates thriving and human flourishing. So X billion pounds of British investments have gone into crypto. That doesn't produce any of that.
Okay.
It's purely speculative. It might be
No, it does.
bank account.
It does. I feel like it's just hidden. So,
but it does not. Like, the reason Britain's economy is so challenged and our GDP per capita is the same today as what it was 30 years ago, when most of the developed countries in the world have doubled, is hugely because we've torn apart the London stock market, and you can't raise money on the London stock market to do anything anymore.
Yeah, and they're all going to
and that affects the real economy. And that's what I've done for 25 years.
To add to to softly challenge your point on jobs and all of that, there are jobs in a lot of in crypto, and what's happening is, because it's a new asset class, it's not as clean, it's not as regulated, and therefore it is bordering on the hidden economy.
But no other asset class in history has gone from $0 to $3 trillion and produced as little real wealth. Like, you're right, there are a few thousand people in every capital city in the world working on crypto stuff, right? Of course. They're all, few of them are highly paid, and they've bought some cars, and they've rented an apartment or bought a house. That's real economy stuff, right? But $3 trillion of capital deployed in the real economy, like building buildings, like buying aeroplanes, opening mines, like building factories, would be of inordinately more value to us as a species
but we've got
than
data
$3 trillion
centers
sitting in crypto.
But we've got the data centers, which the Bitcoin mining companies are leveraging. But
it's de minimis. It's a tiny, it's
not,
tiny fraction.
Yes.
$3 trillion in crypto, or $3 trillion in the real economy. Okay. The $3 trillion in the real economy for the flourishing of mankind would be literally 1,000x $3 trillion sitting in. Think about it. Bitcoin's $2 trillion. Bitcoin isn't opening any shops or employing. Yeah,
Bitcoin is still smaller than Nvidia.
So then, I want to ask you on your point then. So if you think it's producing not that much real wealth, and to you, real wealth is actually like jobs and
it should be to everyone,
right?
That's why we're struggling, because there's no jobs and people are being paid really poorly, and there's no tax receipts, so the government has to borrow money, which is why interest rates go up and mortgage rates get. It's a terrible, terrible vicious circle we're in, because we've destroyed the real capital markets in the UK.
Yeah. So in that case, with Bitcoin, where it's got this huge gap with real wealth, what do you think is going to happen with crypto then? Do you think it will still have this huge gap in the future?
What does the future look like effectively? Because what I can see happening is there are people that invested in crypto 12 years ago. For me, based on what? Then there's people that invested 8 years ago after the first cycle, second cycle. Then 4 years ago. I think if you're investing in crypto now, I categorize you a little bit different to if you invested 12 years ago.
Well, the arguments are different,
because
the valuation's different.
We've seen 3 cycles. There's a bit of data now that you can use to, create price discovery. There is more adoption by governments, by companies, there's by people. And I think if that trajectory continues over a long period of time, it doesn't matter what I think about crypto.
I think that's right, but
can it eventually, even though it takes a slightly different path, can it eventually get to a point where you're happy?
The question is, what's the tangible use case? And I'll give you a couple of other thoughts, right? So the statement, the internet's going to be huge in 1999 was obviously factually true. And the statement, crypto is going to be huge today, is probably factually true.
Yeah.
But in 1999, you didn't know whether you should buy Excite or Lycos or Yahoo or Google, right? And you didn't know whether you should buy Nokia or Siemens or Ericsson, because Apple hadn't even started making iPhones yet. Phones, right? So my point is, so crypto is as big as the internet. Don't necessarily disagree with that. Who the winners are going to be on a 10-year view or on a 15 or 20 or 30-year view, it's still very unclear, right? And it might not even be Bitcoin.
It might not even be Bitcoin.
As insane as it probably will be Bitcoin, because it's so. But Nokia
Bitcoin's
was the biggest
growth will eventually become like a diminishing marginal returns.
Yeah, because of the supply limit. Well, it already is, right? Yeah. But the question is,
and there might be something that look at let's go to the stock market. If you look at Amazon's trajectory, right, before it became the number one stock in the world, and then you look at Nvidia's trajectory to becoming the biggest, it was two very different trajectories. And if you apply that same logic of how can that be, it could blindside you.
But it's a market structure, because when Amazon had 15 years before, passive ETFs became so huge. So Nvidia, market cap, trillions of inflows into market cap weighted ETFs go into the biggest stocks and are a huge self-fulfilling churn. Amazon didn't have that in 2005 or whatever, right?
So there was a blind spot, right? Because you couldn't have predicted that change in the market dynamic at that time. So potentially, you could have got along with it if you were very enlightened within the last few years, and a lot of hedge funds have, right? Yes, but even going back to the .com era, so likewise, I feel like there is a market force that we might not be able to see or visualize now.
Exogenous factors,
right? And those exogenous factors, I think, apply more to crypto than any other asset class.
I think that's right.
And it's that risk that investors who invested 12 years ago took.
Because goes back to my broad point, is because 90% plus of what crypto assets is not doing anything real in the real economy, apart from the people it employs. You're not raising money. When you raise money on the stock market, you raise money to buy aeroplanes or build a factory or, like Tesla, Gigafactory, make cars, right? When you raise money for any altcoin, and even the best, even Cardano or Solana or Ether, right? There's still material uncertainty, other than the people in the ecosystem sitting on their laptops in Bali or Lisbon or wherever they are right now for tax reasons, or the UAE. It's really uncertain what these use cases in the real world economy for human beings.
A lot of them won't be around.
Yeah, correct.
Soon.
But the irony, that happened with .com companies. But at least they were trying to do something real in the real world, like give you internet service or give you a mobile phone or whatever. Like most of the crypto companies are not doing anything of any consequence.
Some of them are trying to,
of course they are, or
believe they're trying to. Right. For example, you look at something like Uniswap. Right.
I don't know that.
I'll tell you what they do. It's a platform that you use to convert Ethereum into some of the other cryptos. Right. So it's an exchange, right? They are already doing something, right? Which is
that's completely
facilitating.
That's totally parasitic. That's like a stockbroker on the stock market, right? But it still doesn't create any real wealth other than for the shareholders and the people being paid by the company, right?
So if you look at what crypto is really trying to do, they're trying to create a whole new system of operating in the world, right? Which is a concept that becomes less believable the more it gets regulated.
But also look at, so one thing always makes me laugh is it wasn't that many years ago that one of the big use cases for crypto was better payments, blah, blah, blah. Visa and MasterCard do X billion transactions a day, and they have for years, incredibly inexpensively and incredibly efficiently, and plumbed into every banking system in the world. And then there's American Express, which is not as big, but it's big. Like, what the hell do we need something that consumes way more energy, is way more cumbersome, has way more code in it, when Visa and MasterCard do the job?
But what I see could potentially happen is Visa and MasterCard start adopting crypto within themselves. Like PayPal has its own crypto already, right? I feel like if you look at blockchain technology, I think there's a lot of positives in it that 100%. Could be adopted into existing companies. And maybe that's the direction that crypto goes. In terms of tokens, I think this is where I do have an issue with crypto, because the token of a project is like...
And the other thing is that these things all go up in price nominally because the dollar's going down in value.
Yes.
Dollar's gone down 90% since the early 70s. 90%.
I did some analysis on Monday. Because in the weakness of the dollar, so I look at the dollar index, and I think in 2019 it was like 89. So I was effectively trying to figure out what the price of Bitcoin should be if we didn't have dollar weakness. And you can do all this in ChatGPT these days, right? With the right prompts, you can just say, right, given the dollar index of 10 years ago.
And then you've got to inflation adjust it with nonsense inflation numbers.
That one actually kills it.
Yeah, M2. You use M2 growth, money supply growth, instead of the inflation number, you get a different answer.
Okay, so I'm going to move us to the next one, because I wanted to ask you this question before we close, right? Debodun is more on the S&P 500, and Andrew, of course, we know you for global.
How to Own the World.
You've got a book, How to Own the World, right? So I'll start with you, Debodun, right? Obviously, when we had our conversation last time, you were more in favor of S&P 500 versus global index funds.
Yeah.
Is that still the stance that you kind of have?
Yeah.
Yeah.
Yeah. I mean, it's the wrong day to ask me, given global has actually had a good run.
Yeah.
But you have your reasons.
Yeah,
why is that? Why do you prefer
So I used to
that?
market make global index funds in the banks, and the institutions that really bought into it and were going long were doing it to diversify their portfolio, not because they really believed it will outperform S&P.
Okay.
Now, if you look at the world we're in today, I don't believe we get to a world where all the countries are top. Right?
Yeah.
There's always going to be forces at play. There's a book called Prisoner's Geography, right, where you get to learn about the different politics and the place each country has in the world, especially the large.
Tim Harford.
I
I think I just bought it the other day, and I can't remember the name of the guy. Anyway, sorry,
can't remember it all for myself.
Yeah.
But
We'll link.
there's a great app called Headway, and it just summarizes books in like 15 minutes. So I use that. But on that basis, I feel like there are some emerging market economies that can do quite well and have good years, but I do feel that emerging markets are more risky than developed markets. Yeah. So if you've got developed markets plus a little bit of higher risk, what you're actually doing in those portfolios is you are taking a bit more risk in the hope that at some point in the future, hopefully maybe if S&P is having a stagnant decade, the emerging market countries will come through and outperform. But my view is that whole picture hasn't been tested for as long as S&P has.
Okay. If you were posh in 1900, an old buffer in a gentleman's club in London, which an investor, an aristocratic investor, because at the time that's the only people who could invest, right? Because they didn't have ETFs and the two of the biggest markets that you would have thought were fantastic were Argentina and Russia.
Okay.
Right. Yeah. Because they'd been amazing for the last few decades, and we all know how that turned out, right? And look, I'm not suggesting that America's going to have a revolution, or they've just elected a communist mayor of New York, right? So there's the wind of change. But my point is just that. So first, the S&P 500 is global anyway, because how much revenues and profits, Apple or the car companies, whatever. So to a certain extent, you get that globalization, but it is also hugely concentrated. And the MSCI World, by the way, at the moment, is still like 65% US equities. Anyway,
that's my point.
So,
exactly.
But I think if you really want to hedge out the potential change in the world dynamic, because I'm always talking about investing from between 20 and 40 years. Mm-hmm. That's how long you want to think, right? Yeah. And I just think ultimately, whether the S&P does 10% and global, like the Vanguard All World, right? The FTSE All World is like 3,000. It's a 4,000 stock index with 3,000 stocks, and it has India and China in it, which are two really important ones, by the way. Look at what India's done in the last few years. Like you're going to be much on a 20 to 40 year view. It's going to be 8, 9, 10%. They're both going to be in that order of magnitude, and whether you get the one that's 10% or 8%, it makes a difference. But you're still going to get a great life changing outcome if you have either. My feeling is America's absolute dominance is probably at risk. And I'd encourage people to read Ray Dalio, who's runs the biggest hedge fund in America, the changing world order. And basically Holland was the preeminent, power in 1600. Britain was in 1800. America is now, might China be in 200 years' time? There are a few, who knows, or India, or who knows. And the other point is that the contribution to indices of performance is asymmetric. It usually comes from a small number of very, very outlier successful companies. So at the moment, that's Nvidia, Apple, Microsoft, blah, blah, blah.
Big tech, basically,
Who knows whether or not there might be a Brazilian one, 2 Indian ones, and 3 Chinese ones.
Okay.
Because if you have the company that
Saudi Aramco,
correct, is actually the biggest company in the world.
Yeah.
So Novo Nordisk, Taiwan Semiconductor, right? So Novo Nordisk is the diabetes and obesity. That's like I think it's 400 billion-ish in Denmark, right?
It's on my watch list,
And it's like, why would you not want to have some of those, in my view? Because I think the probability on a 20-year view that there will be a handful of multi-trillion-dollar companies that come not out of America is high. Yeah. And the difference is going to be marginal. So to me, if you want to hedge and have a higher chance of capturing that growth, I think there are a lot of cultural reasons why American hegemony and American dominance of stock market returns is not a shoe-in.
Really?
Maybe but it could be for another 5 years.
Okay.
But I think in my lifetime,
okay,
just like not just like Argentina, Imperial Russia.
Yeah.
Argentina is the richest.
That could change.
I think there are a lot of strategic challenges to America.
Do you
particularly there's going to be a dollar crisis and a bond crisis, in my view. Trump. Why did Elon Musk just resign? Because Trump's putting through another $5 trillion increase in the debt and deficit, right?
Okay.
And so that continues. There's going to come a point. It's the record of history. It happened to the Brits. It happened to every culture that's ever overborrowed in its bond markets. It comes home to roost. Now, I'm not saying America has a lot of huge strengths, technology being one of them, obviously. But I just think it's not. I think it's just easier if I want to sleep well at night.
So you
it's
think
just
global
easier to
index
have
fund, global,
global. Yeah.
Okay.
You get a load of American stocks anyway.
Yeah.
Do you think that the S&P 500 will stop averaging circa 10%?
Well, it depends what time frame you look at.
As long as possible, the same time,
30,
40 years.
Because that's what people
I think
are
it's
probably
impossible
looking at
to call.
investing, right?
What I'll tell you what, for the next 30 years, for my money, and it goes to your point earlier about the higher the returns and the higher the valuation, the lower the likely returns for the next decade. And you were talking about capping your downside. But so British equities this time last year were 60% cheaper than American equities. 60% cheaper. And British equities are already outperforming the S&P. Over 5 years, the FTSE ALL shares nearly better than the S&P over the last 5 years. It's fascinating, even though everyone thinks Britain's crap, right? And I think from the vantage point of 20 years from now, Britain's probably a buy and America's probably a sell, just based on valuation.
What's the FTSE ALL share averaged? Annually?
We haven't got time to come to this because the reason, but you never invest based on the rear view mirror of the last 20 years. That's not the way to invest, right?
But I feel like with indices, you can do that, and anyone who has done that would have been successful. Like S&P would have averaged its 10%.
I'll say that 20 years from now, the FTSE ALL share from this moment to 20 years from now will have very significantly outperformed the S&P 500 from this moment to 20 years from now.
Absolutely. On an annual...
Annualised backward-looking 20 years. Because of the valuation difference and because of the structural differences. And
okay, so you think America... So let's say, basically, essentially what you're saying, Andrew, is...
If America annualizes 10% over the next 20 years...
No, but it won't.
FTSE,
it won't because of where valuations are.
So, okay, so you don't think it's going to meet
whenever
that
valuations look at the CAPE ratio, you talked about it, whenever valuations are at this elevated level, the analysis shows the next 20 years will not be like the last 20 years. If you buy something that's been performing like a demon for 20 years, it's not going to it's very unlikely it carries on, right?
Okay.
And actually, if you link growth in M2 money supply is a proxy for growth in the S&P.
What's M2 just to explain again?
M2 is basically cash in circulation and bank deposits. It's basically a measure of the excellent supply of money.
Okay.
America has quadrupled the amount of money in circulation in the last 20 years, which basically maps.
So they've been printing.
Yeah, and that also maps perfectly to the performance of gold in the S&P 500, by the way.
Right, okay. So they're printing, you're saying that's having an impact on the valuation of your real return. Your real return. But that's why it's even more important to invest. Yeah. Because if you're not investing in things that are going up in level with that, you're getting very poor, which is what most people are experiencing. Okay.
My curveball is AI. So I think AI is going to do things that we can't fathom.
Yeah, 100%.
Right.
Every new
and
technology
I feel like existing companies, especially in the S&P, NASDAQ, are going to benefit significantly more than companies outside of the NASDAQ. And the thing with the NASDAQ is that it's got global risk incorporated in it because there's so many... this is my thing. If that changes, my stance changes. There's so many global companies who list on the NASDAQ. And when they get big enough, they go into the S&P 500. Separate from companies that are still in local currency around the world. And I think that S&P 500 already captures a significant, realistic amount of global
100%.
Global risk.
I don't disagree with that.
And going back to your point of like you can't give trading to a newbie and they should start with investing. I also have that stance when it comes to global versus
diversified
versus S&P. I feel like you start with S&P, And if you do decide to go to global, you add that in once you can understand your reasoning, which a lot of people...
And crucially, you don't buy the S&P and the MSCI well, because then you're just doubling 65% twice.
Right, you're basically...
They don't understand. Doubling down.
Yeah, you're basically rotating out of one into the other.
ex-US global fund, for example.
Okay.
Yeah.
Just quickly on AI, the last thing I want to say about that is that's right, but also watch out for quantum computing and biotech.
Yeah, I said that in the last. Yeah, was it on the real? I said, quantum computing.
You mentioned quantum computing and they say biotech. Actually, okay, just before we talk into the opportunity, what opportunities are you looking at for yourself into the future as well?
Well, we talked about this before. I mean, obviously, I've just written a book about biotech. And I think biotech, what people don't understand is just how it can revolutionize so many elements of what we do as a species technologically, like computing power, as well as therapeutics, as well as environmental degradation, as well as whatever, right? But what I conclude, rather disappointingly, some people have told me at the end of that book is, and what do you do to get a proxy on that? Kind of to your point about AI, buy the S&P or a global index fund.
Honestly.
Because what I don't
they are the companies that are going to know how to...
all the big biotech success stories, both biotech companies themselves and lots of other companies using biotechnologies in the index will be in the index.
Yes.
So you'll benefit from that.
Yes.
Okay, cool. So final question to you both. Can someone with a small amount of money realistically achieve financial freedom through the stock market? And what's the best approach for a beginner to make their first investment?
The crucial thing is, with a small amount of money, that's fine, as long as you make a 20 to 40 year commitment to do this every month with whatever you can afford without fail. You have a very high chance of being fairly wealthy.
And you think that's the global index funds? Or ETFs?
I would say it's a mix based on your age of aggressive things, which would include equity index funds, and defensive things, which we can get into, like gold and a few other things. But if you get that mix roughly right, based on your age, broadly, and you do it every month for the whole of your adult life, you'll become a lot wealthier than most people would dream is possible. And that is the wealth secret understood by most rich people.
With less headache as well.
Yeah. Actually, just to ask you about the mix. Okay, let's say, assume, and you said based on age, let's say 20 to 40.
So in my second book, I explain this thing 100 minus your age, which has been around since probably the 40s with American advisors. And John Bogle, who's the founder of Vanguard, talks about it a lot. So it's basically very simple is, if you 100 minus your current age, it gives you the percentage to invest in aggressive things, high return, high risk things. So that would be the stock market.
Okay.
So if you're 20, 80% stock market, 20% defensive, which for me is easily achieved with bonds and cash, basically. You can nowadays longer life expectancies. We work longer. You can potentially maybe make it 120 minus your age. So a 20-year-old could just have 100% in equities. But what that means is as you get older, every 5 to 10 years, you change that allocation. So when you're 60, because if you have 100% of your money in the stock market and you're 60 and you're about to retire, and there's a 50% market crash, that's a really, really bad outcome. It's like that's catastrophic. That will ruin your life. That's why you have to bear in mind this 100 minus your age idea.
Okay, great. Thank you so much, Andrew. Debodun, what about you?
I feel like you can. I mean, if you take a number like £100 and you put into an index S&P that gives you 10% over 25 years, that's 125k tax-free if you're doing a nicer.
Yeah, exactly.
Right, and that's that first 100k that we will talk about, that after that building wealth becomes a bit easier. I think if you apply it to children and you start actually telling,
be even more powerful.
It can be even more powerful, because if you can actually tell your child, a lot of people invest for their kids, and they just give them the money at. If you bring your child from the age of 3, 4 along the journey, mummy bought stocks for you, and they don't need to know what stock is, right? But it's £50 today, it's £500 now, and you just take them along that journey.
And they'll be blown away by how much money they have on their 18th birthday.
When they get to 18, they want to keep the cycle going because they've seen how much it's grown, and by then they would have learned a bit of life as well and realized how privileged they are, how much, it's grown by that amount. They'd actually get into a habit where they want to contribute more when they start working.
Yeah, 100%.
Right, and I think
they see the fruits of it.
This ultimately is how you build wealth, especially when we start talking generational wealth.
Exactly.
I think there was a statistic I read where I think 64% of wealth is actually built through inheritance, when generational wealth, that is. but it actually starts with education.
Well, the other one though is 2/3 of multimillionaires' families have lost the money within two generations.
So yeah, this has been a great conversation. I really enjoyed both your viewpoints. I think we definitely need to do a part 2 because there's a lot of other areas that we need to definitely talk about. So we'll see what people say. Where can people find you if they want to reach out?
PlainEnglishFinance.com and also Plain English Finance on YouTube.
Okay, thank you, Andrew. What about you, Debodun?
Stock Pickers Academy on Instagram, Debodun Osekita on LinkedIn.
Okay, amazing. Thank you. I hope that you've enjoyed this episode of the podcast. See you next week's episode. If you enjoyed this episode, share your favorite part in the comments, tap the like button and subscribe to the channel. Your support is really appreciated. We'll keep working hard to bring you more valuable conversations.